Hi, and thank you for dialing into the Anatomy of Recession, what to look for and where we're headed. My name is Jeff Scholze. I'm the investment strategist with Clearbridge, and what that really means is I'm responsible for coming up with the firm's macro and market outlook, not only here for the U.S., but for the international space as well. And it's a role that I stepped into in early 2017, and knowing that I was going to move into this role, I did what anybody would have done. I did a lot of research. I looked at historical trends, and I came across a very interesting phenomena, that there's only one thing that you need to know in order to become a much better investor and a much better asset allocator throughout your lives. Just one thing. Now, I'm not going to share that thing with you quite yet. I need to let the suspense build here, but you're going to find out what that is. I'm going to talk to you about Clearbridge's economic and market outlook, and then I'm going to go through 8 drivers that I think are going to move the market, or at least it's going to be the narrative for the market throughout the course of the year. So we're in the 9th year of this bull market. It's quite extended, and we use the terms bull market and bear market all the time in financial markets. But does anybody know what the origin of the term bull and bear market is? Interestingly enough, it's how each animal attacks. So when you think about a bull, when they attack with their horns in an upward motion, a rising market, hence a bull market. And when a bear attacks, they attack with their claws in a downward motion, a declining market, hence a bear market. But in any bull market, we have what we call the wall of worry. Things that could happen. It preoccupies investors, but most of them never end up materializing. If you look at the list that you see in front of you, I'm sure you've been concerned about a couple of these over the last couple of years. But this is where the average investor starts to get it wrong. They fail to account for the difference between probabilities and possibilities. Although all of these are certainly possibilities, the probability suggests that this market cycle, that this economic cycle is going to continue to move forward. But just for fun, I went and I looked at all of the scary events that we've had in the market, and I've overlaid them over a chart of the S&P 500. As you can see, we've had quite a few of them. And I've labeled each one of these scary events as panic attacks. So I'm not sure if anybody listening has ever had a panic attack before, but if you have had one, you recognize that a panic attack comes out of nowhere. And right at that point of maximum discomfort, when you just can't take it anymore, the panic attack goes away as quickly as it came on. And there's an important parallel here to investing. So when the average investor is going through one of these panic attacks, whether it was the elections last year, Brexit, maybe when oil hit $27 a barrel back in 2016, right at that point of maximum discomfort, when you just can't take it anymore, the average investor sells. And when the markets recover and they feel good about things again, they rinse, wash, and repeat the process all over again. And I think that this panic attack mentality is summed up best by the quote at the bottom of the page by Albert Einstein. The definition of insanity is doing the same thing over and over again, but expecting a different result. But unfortunately for the average investor, the results have not been that good. So what we're looking at here is a study by Dalbar. And they looked at the 30-year annualized returns of all the major asset classes in the U.S. from 1985 to 2014. All the way to the left, you can see that REITs did the best at 11.2% annualized. But all the way to the right, you can see that average investors fared the worst. They only garnered a 2.5% return per year over the course of this timeline. They didn't even keep up with inflation. Now think about that for a second. The average investor investing in one of the biggest bull markets in U.S. history for not only stocks but bonds. Over the course of the 30 years, the average investor has less purchasing power than they did when we started this epic run back in the 1980s. And a big reason for that is because they couldn't distinguish between the noise and the signal. The noise is the S&P and the panic attacks that we have every day. Everything that you hear in the news day in and day out, it's really just noise. But the signal is much more clear, and this is what I alluded to at the very beginning of this conversation. The signal is whether or not we're going into a recession, because recessions and market crashes, they coincide with one another. Because everybody knows here what a recession is, right? A recession is a drop of GDP for 2 consecutive quarters. But what exactly is a market crash? There isn't really a textbook definition for the term. Well, to start, we can define a bear market. A bear market is a decline of the S&P 500 of 20% or more. So that begs the question, is every bear market a market crash? And we'd make the argument that if it lasts less than 12 months, probably not. And the example I'd like to give is back in 2011. If you remember back 7 years ago, 2011 was a pretty scary market environment. Everybody was scared of that double-dip recession, similar to the 1930s. You had the U.S. debt downgrade. You also had Greece threatening to blow up the European Union. And from April in 2011 through October, the market did lose 20% of its value. But if an investor just stayed the course for 3 more months, by January 2012, the market was reaching new highs. So in order to be called a market crash or kind of be worthy of that designation, we feel that you need to see some persistence or some duration to that downturn. So let's define a market crash as a bear market that lasts longer than a year. And by that definition, over the course of the chart that you see in front of you, so roughly the last 40 years, there's only been one market crash that didn't coincide with a recession. It happened between 1987 and 1988. So there was a very famous market event that happened in 1987. It was actually on October 19th. And if you're not familiar with it, it was Black Monday. Black Monday saw a 22.6% drop of its value in one single trading day. It was the only single day bear market that we have on record. So it got me thinking, how often do these one-day crashes happen? And the second largest drop in one single trading day in U.S. history happened 58 years earlier during the Great Depression in 1929. The market only lost 12% of its value that day, so it's a far cry from the 22% that we saw on Black Monday. So if these one-day crashes happen every 58 years, that means that the next one's not due up till 2045. So what I'm trying to get at here is that if we treat Black Monday's crash as an outlier because of A, how often these one-day crashes happen, but B, the sheer magnitude of the drop that we've seen on Black Monday, that means that we're left with 3 market crashes in one near crash, all coinciding with the last 4 recessions. Market crashes and recessions go together. And it's not to say that it's foolproof, right? Black Monday's crash teaches us that we can never say with 100% probabilities that something will or won't happen. But again, this is a game of probabilities. And from our perspective at Clearbridge, we think the probabilities of a recession and thus a market crash are fairly low in 2018. We think the probabilities are less than 10%. But how do we get to that number, less than 10% probability of a recession? Well, first off, you need to determine what type of inflationary environment you're in because it's going to highly affect the length of your recovery. So what we're looking at here is every U.S. expansion since 1960. The average expansion has been 27 quarters long. But if you strip out the 2 high inflationary periods of the 70s, the average low inflationary periods were a little bit longer. They were 33 quarters apiece. And I'm sure a lot of you listening would be surprised to know that we just hit that average in Q3 of 2017. So we just hit it. But let's not forget something, right? The average is the average. Some of these recoveries are longer. Some of these recoveries are shorter. And if you think about how much central bank accommodation that we've seen, not only from the Fed, but from global central banks, and the fact that we have some fiscal stimulus, we'd make the argument that this economic cycle has much further to go. But we need more information than just whether or not we're in a high inflationary environment or a low inflationary environment. The problem is most investors like to find one data point and they think it can tell them the whole story, but it rarely ever does. So a good analogy for this is if I said the word pear to all the listeners. Pear. With no other context, one listener might think it means a pair of shoes, another listener might think it means to pear an apple, and a third listener might think it means to actually eat a pear. But it's only when you can put words together, or in this case, data points to form a sentence, where you can more fully understand the situation. And that's why we've come up with the Clearbridge Recession Dashboard, a list of 12 variables that have historically foreshadowed an upcoming recession. And they go across the 4 fault lines of the U.S. economy. They look at business activity, consumer health, inflation, which of course is important from the Federal Reserve standpoint, and then last but not least, financial stresses. So as you can see on the column on the left, out of the 12 variables, 11 of them are green, with 1 flashing yellow, and corporate profit margins was recently upgraded due to tax reform and higher revenue growth. So nonetheless, with 11 flashing green and 1 yellow, we think that if we have a recession, it's going to be 2019, 2020, or possibly even later. But also, let's look at this dashboard and see how it performed over the last 7 recessions. So we've stress tested this dashboard very extensively, and as you can see, going into the last 7 recessions, you've seen a lot of red and a little bit of yellow. not much green. So with the dashboard solidly green today, that's why we feel like we have some confidence that the U.S. economy is going to continue to move forward from here, at least over the next 12 months. But before we get into some of Clearbridge's indicators, let's look at something by the Conference Board. It's called the Leading Economic Indicator Index. It's a group of 10 variables that tend to move prior to the actual economy. But what I want you to take away from this slide is if you look at the top right, on average it takes you about 6 years once you eclipse the previous cycle's peak before you hit the next recession. And if you look at the top right, you can see that we just went above the previous cycle's peak, which was in 2006, last year. So I'm not saying that we're going to go another 6 years before we hit the next recession. I think that may be wishful thinking, but it wouldn't be a surprise to us at Clearbridge if we go another 2, 3, maybe 4 years before we hit that fate. But also, the Conference Board Leading Economic Indicator Index has done a very good job of foreshadowing an upcoming recession. Just a quick reminder, those dark gray bars are recessionary periods, and as you can see, the LEI goes below zero before each and every recession. If you look all the way to the top right of the screen, you can see that the LEIs are still climbing, which tells us we're not close to recession anytime soon. But two of the indicators that are in the LEI but are also in Clearbridge's dashboard are building permits and the yield curve. So we're looking at building permits here in the United States, and as you can see, building permits have dove down aggressively before each and every recession going back to the 1970s. The average lead time that it gives you is around 2 years. So if you think about it, when a builder goes out, they get a permit. They build a house, they sell that house to somebody, and then whoever buys it needs to furnish it. So from permit to furnishing, that timeline is about 2 years. So it makes sense why building permits gives us so much advance warning. And housing-related activities make up about 16% of our GDP. So that's a pretty big headwind or tailwind to our growth. If you look at the right-hand side of the chart, you can see that building permits are still firmly in an uptrend, and we think they're probably going to go higher from here because just to keep up with population growth and demolitions, we need 1.4 million units per year, and we're not even at that level quite yet. Also, if you think about housing, there's a lot of positive drivers that are still out there. Rates, even though they've risen recently, are still relatively low, so affordability is high. Banks have finally gotten through Dodd-Frank, and they're able to finally lend to consumers. But last but not least, and I can't stress this enough, I think that the millennial generation is going to want houses just like previous generations have. It's just taken them a little bit longer to get there. And the oldest millennials right now are in their mid-30s, where they get married, buy a house, have kids, want the nice school district. And I think housing is going to be a source of strength in the U.S. economy over the next couple of years as the millennials move into home ownership a little bit later, though, than previous generations. The yield curve is another indicator that is in Clearbridge's dashboard. As you can see from this chart, the yield curve has successfully predicted 7 out of the past 7 recessions going back to the 1960s. So what is the yield curve? All the yield curve is, it's the yield that you get on a 10-year Treasury or long-term money minus the yield that you get on the Fed funds rate or short-term money. In normal economic times, it's positive. You're getting more yield on that 10-year Treasury than you are on the Fed funds rate. But right before a recession, it inverts. You're actually getting more yield on that Fed funds rate or short-term money than you are on the 10-year Treasury rate. And one of the reasons why this causes a recession is because banks will typically borrow short at that Fed funds rate, and they'll lend it out to individuals, businesses, and consumers at that 10-year Treasury rate or the long-term money rate. But if you have an inverted yield curve, there's not much incentive for banks to lend, so you end up seeing a contraction of the supply of credit to consumers and businesses, and you have a recession generally about 1 year after that point. So if you go back to 2007, if you're looking at this indicator, the U.S. was in an inverted yield curve situation, but also most major economies around the globe also had an inverted yield curve at the same exact time. It's actually a very rare phenomena, and if you're looking at this indicator, you would have recognized that it's not going to be a U.S. recession, but it's going to be global and deeper in nature. So if you look at the right-hand side of the chart, you can see that the yield curve has been flattening. We're not at levels that are concerning for us at Clearbridge yet. The yield curve is still over 100 basis points steep, which tells us that the incentive to lend is still out there for banks. Average hourly earnings tend to mark a late part of an economic expansion. Generally speaking, when the average hourly earnings goes above 4%, you have a recession about 2 years after. If you look all the way to the right, we've had a very difficult time generating any type of wage growth, but it is on the move higher from here. But again, we're far away from that 4% threshold where it eats into corporate profit margins and doesn't give corporations the incentive to hire or invest in their businesses. But there's one more thing that you need to take into consideration when making your recession call, the consumer, because the consumer's king here in the U.S. This slide tells you how big consumer spending is here in the United States. So our consumer spending is bigger than the next 4 largest countries combined by over $1 trillion. And from our vantage point here at Clearbridge, we think the consumer might be in the best shape they've been in post-crisis. We have record amounts of job openings, which means the people that have left the workforce have an opportunity to come back in and get gainful employment. We have cycle high quits, which means people are feeling good about their job prospects and going out and getting that pay raise. You have household net worth up over 40% from the highs that we saw in 2007. And then lastly, consumers are spending the least on record to service their debt, with interest rates being as low as they are. So if you put that all together, we don't think that you have consumer spending that's going to ratchet up to 5 or 6% GDP growth anytime soon. But we do think the consumer is in a good enough position to keep the spending at these levels, to keep this slow growth train moving forward over the next couple years. So let's put this all back together. Why are we talking about this? We're talking about this because we're trying to figure out whether or not we're going into a recession. Because recessions and market crashes, those deep drawdowns that shake investors out of their asset allocations, they coincide with one another. And because we're in a low inflationary environment, because of the recession dashboard that we've come out with at Clearbridge, and because of the consumer, and the consumer makes up 70% of our economic activity, because of those 3 dynamics, we think the odds of a recession and thus a market crash are less than 10% over the course of the next 12 months. So Clearbridge's outlook is for 2.8% GDP growth here in 2018, coupled with a market that sees high single-digit, low double-digit returns when all is said and done. Think 8 to 12%. And one of the reasons why we think that the market and the economy will continue to move forward is because we're seeing a pulse of global growth that we haven't seen in quite some time. So this is looking at the number of countries in the world in a recession in a given year. And if you look at the IMF forecast for 2019, if they're right, we will have the lowest number of countries in recession ever in the history of the world, which is 5. So while the U.S. has helped the rest of the world grow for the last 7 years, I believe, now that we're late cycle, that it's the rest of the world's turn to help the U.S. grow now that we're in the 7th inning of our ball game. So global growth is going to help the markets and the economy move forward. The U.S. economy is on solid footing, obviously from the recession dashboard that we looked at previously. And you also don't have a Fed that's tightening too quickly. And if you think of most recessions, a lot of recessions are caused by an over-aggressive Fed. A Fed, generally speaking, is concerned about inflation at the end of a monetary policy cycle, so they tighten short-end rates too much and they end up choking off the recovery. One of my concerns coming into 2018 was that with tax reform in tow, that the Fed would feel that it's inflationary and tighten aggressively in 2018. But if you looked at the last FOMC minutes from December with the dot plots, the Fed increased their growth expectations for 2018, 19, and 20, but they didn't increase their inflation forecast, which tells us that they're going to continue to tighten in a very slow and methodical manner, and they're not going to get over-aggressive and choke off this recovery. So those are the 3 dynamics why we think the market and the economy will continue to move forward. But people talk about this being a different type of cycle, and I think this slide really illustrates why that is the case. So everyone talks about this being slow growth. Well, if you look at all the other recessions and expansions that we've had since World War II, this truly is a different type of experience. That blue line at the bottom is where we are today, and if you take the downturn and the rebound into consideration, we're at about half the levels that we've seen for the average rebound going back to World War II. So although this is a very long cycle, the growth this cycle has really been subpar. And low growth can cut 2 ways. It's very frustrating for consumers and for business owners because you haven't seen that V-shaped recovery that we've typically have been experienced, but we've been typically accustomed to. But the upside is that if there's no boom, there doesn't necessarily have to be a corresponding bust. But I will say that Q1 has historically been a quarter where you've seen some weakness economically speaking. And if history is any indication, we could see that again here in 2018. So as you can tell by the chart, Q1's growth has been about half of what we've seen in Q2, Q3, and Q4. A lot of that is weather related, and with this being one of the coldest winters on record, if we do get a weak print in Q1 and we get some weakness from the market, we would view that as a buying opportunity because those dynamics we just talked about are still very strong. But that doesn't mean that there aren't going to be things that drive the market or the narrative here in 2018, and these are 8 that we've highlighted at Clearbridge that could be potential flashpoints. Trump's presidential agenda, China, valuations, Europe, earnings, student and auto debt, interest rates, and then last but not least, what presentation wouldn't be complete without Bitcoin? So let's talk at each one of these in a little bit more depth. So first off, let's talk about Trump's presidential agenda. So coming into 2017, there was a lot of investors concerned about this new president. Not so much because of tweets or anything of that nature, but just because the presidential cycle tends to correspond with the economic cycle. So as you can see, really since the post-World War II era, most recessions have come in either year 1 or year 4 of a presidency. And the big reason is a lot of the fiscal stimulus that you see will happen in years 2, 3, and 4. And that fiscal stimulus runs out in year 1 once somebody has been elected or reelected to the presidency. And the reason why year 1 is so crucial is it's 3 years away from that potential reelection. So if you're going to have a recession, year 1 is the one to do it. But nonetheless, we've made it through 2017 without a recession in Trump's first year in office. And now we're in the sweet spot, if you will, for the presidential cycle and recessions. In years 2 and 3, over the last 70 years, we've only had one recession, and we've just passed some fiscal stimulus. And I think that we still will dodge a potential recession over the next couple of years. That should give us a little bit more juice going forward. But it doesn't mean that there won't be market volatility. And so far here in February, we've seen quite a bit of market volatility, and this is par for the course. And you usually see a heightened level of volatility during midterm elections. So since 1962, the average correction that we've had in midterm elections has been 18%. So it wouldn't be a surprise to us if we get a 10, maybe even a 15% pullback this year after last year's biggest drawdown of being 3%. But that dip should be bought because the 1-year price action after that correction tends to be very strong. Over 35% is the average rebound that you see after a downturn in a midterm election. So it remains to be seen how deep of a pullback that we'll get this year, but nonetheless, it should be bought because we think that the dynamics for this market cycle and this economic cycle are still very strong. I believe there could be some more upside for a lot of the sectors that are beneficiaries of tax reform. So we looked at the companies that have the most to gain or lose from tax reform. So we formed 2 baskets or 2 portfolios. One is low tax companies, companies that have the least to gain from tax reform. They pay the lowest effective tax rate, so tax reform isn't really going to help them. And companies that are paying the most in effective tax rates, the companies that have the most to gain from tax reform. And that's the blue line that you can see right there. So right after the election, those high tax companies outperformed by a wide margin because with a Republican Congress and a Republican president, there's high expectations that tax reform would be a shoo-in. But right around January, you can see that those low tax companies started to catch up, and they were outperforming on a relative basis. Now, we made the argument at Clearbridge all year long that the tax reform was not priced into the markets, but as soon as we got some visibility in December that that was going to be the case, those high tax companies caught up very quickly and have narrowed the gap. But nonetheless, I do think that there's some more upside there because if you listen to company estimates, you listen to analyst estimates, there's a very wide degree of thoughts on what tax reform will do to the bottom line. In our opinion, that means that there's probably a little bit more upside for those areas of the market that have been most affected. But with tax reform specifically in mind, I think that repatriation could cause some opportunities for healthcare and information technology. So being in a worldwide tax system, what that really means is if you have a U.S. company that sells something in, say, England, England wants to tax the sale of that good, but then the U.S. wanted to tax it again. when you brought it back to the domestic country. So because of this tax system, companies haven't wanted to bring that money back home for quite some time. And over the course of the last 30 years, they've built up a unremitted foreign earnings of over $3 trillion. But with tax reform and us moving over to what we call a territorial tax system, that money is being forced to come back home. And healthcare and IT have the biggest percentage of their market value abroad. And we're really excited about healthcare in particular. And if you think about a lot of that money, it's in areas like Big Pharma, and Big Pharma is trading at a premium compared to biotech. It's actually the first time in market history that that is the case. So if you have Big Pharma with a lot of money and biotech companies trading at very cheap valuations, we think that that's a pretty nice combination for higher M&A activity. And if you look at 2018 thus far, it seems like that indeed is the case. And we think that that's going to be a theme going through the course of the next couple of years. But nonetheless, we think healthcare and IT are going to be two sectors that benefit from tax reform. Now, the earnings picture has solidified for quite some time, and we were bullish on the earnings picture really since 2016. And there's a very good way to gauge whether earnings are going higher or lower is by looking at manufacturing PMI. So for those of you not familiar with manufacturing PMI, all it is a survey that's given to manufacturers asking them how business conditions are, but also how business conditions look to be in the future. And as you can tell, manufacturing PMI leads earnings by about 6 months. If you think back to late 2015, early 2016, a lot of people are very concerned about the economy and about the markets and about earnings specifically. But manufacturing PMI, if you're looking at this metric, it bottomed in December of 2015. And sure enough, 6 months later, we're out of the earnings recession, we're out of the economic slowdown, and the market moved up substantially higher. So where are we today with manufacturing PMI? Even though we're a little bit below the peak that we saw in late 2017, we're still at a very elevated number of close to 60. Which tells us even though earnings have been great, and they've been great for the last 5 quarters, we think earnings are going to continue to surprise on the upside over the course of the next 2 quarters. But another reason why we think earnings will continue to surprise for the upside is share buybacks. So I think this slide does a very good job of illustrating how strong share buybacks are. So at the top there you have the S&P 500, and below there you have dividends and share buybacks. And they're essentially mirror images of one another. To put it in perspective how important share buybacks are, if you look at 2016, the amount of money that was done in share buybacks was $550 billion. That's a pretty big number. But if you think about all the money that went into the equity markets for active and passive combined, it was close to $175 billion. So share buybacks were almost 3.5 times the size of a market buying than all investors combined. So you never want to underestimate the impact of share buybacks. The good news is that share buybacks should continue to be strong in 2018. If we didn't get tax reform, I would have been a little bit nervous that they could potentially go down. But with repatriation happening and all of that money coming back home, a lot of estimates feel that share buybacks could go up 10 or maybe even 20% from the levels that we saw in 2017, which means that the biggest buyer of equities is still involved in the market. But also, tax reform should make earnings estimates much higher from here. We think that you could see earnings go up as much as 15% in 2018. And historically, that's been a very good sign for equity investors. So if you have a year of positive 10% or more earnings per share growth, your average annual return is 11%. If you don't hit that bogey, it's 7%. So even though we've had a nice stretch of market performance, we think with the positive earnings that we're going to see from tax reform and just better revenue growth overall, we think that we'll hit that 10% bogey fairly easily this year, which should be a positive experience for markets and for participants. Let's talk about China. China was an area that had a lot of fear a couple of years ago, and you haven't heard very much on that front for quite some time. But I like to look at both sides of the coin, if you will, when evaluating anything to determine what's the best course of action. So we're going to give you the bull and the bear case for China. So what we're looking at here is the bull case. So everybody knows that China has a lot of people. Let's put those people in perspective. So China has 415 million millennials. That's 100 million more millennials than Western Europe, the U.S., and Canada combined. So that's a huge demographic, and it's an educated demographic that's reaching their household formation years, the years where they're going to spend more money than they've ever spent in their lives. So we think being in China, it's good to have exposure to this demographic, and we think consumer staples, consumer discretionary, and IT are the best ways to play this. Wayne Gretzky was famously asked why he was such a good hockey player, and he responded that he doesn't skate to where the puck is, he skates to where the puck is going to be. And in China, the puck is going to be in these consumer-related companies, but also within the IT space. But let's talk about the bear case, right? So everybody knows that China has a lot of debt. Let's put that debt in perspective. So what we're looking at here is bank loans or corporate loans in China. And their corporate loans have gone up substantially since 2012. It's gone up close to 100% of GDP. Now, that number doesn't really mean much to a lot of listeners. Let's look at it a different way. Chinese bank loans or corporate loans have gone up the size of Canada for each and every year since 2012. So 2012, Canadian GDP, 13 Canadian GDP, and so forth. And for those of you not familiar with how big Canada is, it's the 10th largest country in the world. And with all this debt, you would expect higher economic growth, but economic growth has actually declined from 16% down to 11%. So what that tells us at Clearbridge is a lot of this money is going to what we call zombie companies, companies that should probably be put out of business, but they're being kept alive. And in China, stability is the number one priority, with maximizing economic productivity as their second priority. But there's an important change that has happened here recently. They went through their party congress in November. It's essentially a 5-year re-election process. And now that leadership is back in charge and they've solidified their power for the next 5 years, I believe that a lot of these zombie companies are going to be taken out of China's system. Now, China's been able to walk the tightrope for the last 10 years, and I'm not about to bet against them that they won't be able to do it. But let's just say worst-case scenario is that they don't walk the tightrope and they end up tightening too much or cause a bigger financial collapse. Well, they definitely have a playbook from what we've done here in the U.S. back in 2008. They're going to cut rates to zero. They're going to recapitalize their banks. They're going to slash reserve requirements. And they're going to be able to get through it because we've already done it about 10 years ago. But I don't think that that's a high probability. I think China will avert the hard landing scenario, and they'll be able to their growth might come down a little bit, but I think that when they get through this, they're going to be stronger than they were going into it. Also, I think a big boost to Chinese equities over the course of 2018 is their inclusion in the MSCI indices. A lot of investors, quite frankly, are underweight China, and as they get included in those indices, I think that's going to create a lot of demand for Chinese equities, which could be bullish for them longer term. But let's just take the bear case into consideration. What if it is a hard landing? Well, I don't think it's going to be bad for the U.S., or at least the U.S. economy, because, quite frankly, we don't export much to China. We export about 60 basis points of our GDP to China, which is less than 1%. So while China exports quite a bit to the U.S., we don't necessarily export much to them. So if they do have a hard landing, the U.S. economy should be fine and should continue to chug forward. It's not to say that we wouldn't see some financial market volatility and a pullback of 10, maybe 20, maybe 25%. But nonetheless, that should be a shallower pullback because it doesn't and it won't correspond with a recession, in our opinion. But let's move over to Europe now. We are bullish for Europe at Clearbridge, and this is one of the slides and the reason why that's the case. So the U.S. has grown faster than Europe for a vast majority of this recovery. And at the bottom, you can see that the bottom of the chart shows you that the U.S. is growing faster, and the top of the chart shows you that the European Union is growing faster. And a lot of people forget that Europe had a pretty nasty recession in 2011. They had 19 countries trying to go under the same monetary policy, and it took them a little bit of time to figure that out. And unfortunately for them, they had a recession in the meantime before they can get everybody on the same page. But nonetheless, since Strategas do whatever it takes moment, you've seen European GDP pick up, and now they're growing at a faster rate here than the U.S. So that's one positive that I think will continue over the next couple of years. Also, Europe is earlier in their monetary policy cycle. So while the U.S. is doing things like raising rates, doing balance sheet normalization, Europe is still doing things like QE and negative interest rates. Also, valuations are lower, quite frankly, than what we have here in the U.S., and I think that populism, which has plagued Europe for quite some time, I think it's going to take a back seat because of the higher growth that we're seeing. I don't think populism is necessarily dead, but I don't think it's going to rear its ugly head, at least for the next couple of years. So because of all those dynamics, we think that Europe is a very good opportunity for investors over the course of 2018 and 19 as well. But also, if you think about the U.S. versus the international space, it's cyclical just like anything else in our economy. The underperformance or outperformance tends to happen for long periods of time. So what we're looking at here is the U.S. versus EC performance ex-Japan. And as you can see, one outperforms the other, generally speaking, from anywhere from 3 to 10 years. Now, if you look at the right-hand side of the page, you can see that the U.S. has been outperforming the EC ex-Japan for roughly the last 10 years, and we believe that the pendulum has swung back to the other direction, that the international markets will have the better relative upside to the U.S. markets over the next couple of years. Again, we don't think the U.S. markets are going to do bad. We just think that there's just a little bit more upside internationally speaking. So interest rates are an important topic, and with the 10-year Treasury on the slide saying 2.4%, it needs to probably be updated to reflect a much higher rate environment that we've seen to start 2018. So I think interest rates are going to go up and going to continue to go up for a variety of reasons. First off, the Treasury is going to issue a lot more debt this year than they have in 2017. So as you can see, in 2017, we issued about $500 billion worth of debt. That's going to increase to $870 billion of debt this year, which is an increase of 68%. That's a combination of quantitative tightening or balance sheet normalization, the Fed unwinding some of the treasuries off their balance sheet, but also bigger fiscal deficits, of course, with the tax plan adding to that deficit even more. So whenever you have more supply of anything, there's got to be an equalizer, and we think that that equalizer will be higher yields and lower bond prices. Also, we should get a near-term boost in growth from tax reform, should boost up the 10-year Treasury yields. We think that inflation has firmed and bottomed and will continue to move towards that core PCE number of 2% that the Fed's been trying to hit. But also, we think that what's happening in Europe will have an effect on U.S. yields. So European bond markets are distorted. And this slide will tell you everything you need to know about that distortion. So what we're looking at here is the 10-year Treasury here in the U.S. versus European high yield. They're almost yielding the same amount, which is a little bit of an aberration. If you think about the risk-free rate here in the U.S. yielding the same as the riskiest companies in Europe, we think that that is something that will need to correct itself. And we think that 2018 will be the year where you potentially see that. So the ECB, or the European Central Bank, has had a much bigger distortion in their markets than the Fed ever did here in the U.S. To put it in perspective, at no iteration of QE did the Fed ever buy 100% of the issuance that the Treasury had, at not one point. If you look at the ECB over the last year, according to Deutsche Bank, they have bought 7 times the net issuance of bonds in the Eurozone. 7 times versus not even 1 time means that bonds over in Europe have been distorted much more so from monetary policy than what we've had here in the U.S. But if you think about what's happening in Europe, their quantitative easing program is going from $60 billion per month down to $30 billion, and that's already taken effect here in January. We think once we get to September, that QE program will be done. But what it's going to do, it's going to push European yields up higher than they are right now. But it's also going to take that marginal buyer that's from Europe that came over to the U.S. to buy 10-year Treasury yields because you're getting that yield enhancement. It's going to bring them back home in favor of higher yields finally domestically. And that's just going to take a little bit more demand out of U.S. 10-year Treasuries. So because of all of these dynamics, because of that less European demand that we're going to see, because of the surge of Treasury issuance, because of a firming up of inflation and a pulse up of growth, we think that yields are going to continue to move higher over the course of this year. It wouldn't be a surprise to us if we hit 3% by the end of the year. We may overshoot to hit 3.25%, but we don't think that it's a danger for equities until we get up to 3.5%, and we're far away from that point, at least here in February. The one thing that will potentially be an issue for fixed income holders is duration. However, interest rate sensitivity globally has gone up substantially since 2009. When it was 9 years, it's been up to 13.5 years of duration, which means these sell-offs, these backup of global yields, is going to be felt much more so in fixed income portfolios. The important point here is that if this rise is gradual, you should still have positive total returns. But again, if you see a very steep backup, you could start to see some negative returns from your fixed income portfolio, and this could create a situation where you have a rotation from bonds into equities because the bond investing is no longer a one-way street. But nonetheless, our expectation is for a gradual rise, not something that's very steep and aggressive. So Bitcoin is the very hot topic now in financial circles, and similar to what we did in China, I want to give a bull and a bear case for Bitcoin. So this is the bull case. So Bitcoin's market capitalization is around $200 billion. It's a very small amount compared to the U.S. monetary base, which is close to $4 trillion. All the gold ever mined, which is $12.8 trillion. The U.S. stock market, which is $27 trillion. If you think about all the currencies around the world, it's closer to $30 trillion. So a $200 billion valuation could be very small. And if Bitcoin gains more notoriety, gains more acceptance, that could be a number that's substantially higher. And this is the case that bulls will hang their hat on. But I think the bear case is a little bit more compelling at this point. So what we're looking at is Bitcoin's ascension in 2017. And what we compare that to the NASDAQ bubble, the Japanese bubble of the 80s, the epic run that gold had in the 2000s, and last but not least, the housing ascension that we saw in the 2000s as well. And just in 2017 alone, Bitcoin has trounced all of those major bubbles that we've seen throughout history. In fact, if you go back to 2013, when Bitcoin was $13 a Bitcoin, it was up over 500 times. At today's levels, it was 1,000 times not too long ago. And this big bubble is bigger than the tulip bubble that we saw in the 1600s, which is arguably the biggest bubble that we've seen in history. So I think that there's a little bit more downside for Bitcoin from here. And quite frankly, there's no proprietary thing about Bitcoin that makes it the best cryptocurrency versus all these other cryptocurrencies that are coming out. So anybody can come up with a cryptocurrency, so why will Bitcoin be the one that wins at when we look back 5 or 10 years from now? But last but not least, I think there's a very big risk because governments like to tax. And if you have something that's outside that taxing purview, that's outside the monetary system, I think governments will not take a liking to that, and they're going to find ways to either regulate it, and if they can't regulate it, they can shut it down. So if Bitcoin does get to the levels that people, or the bulls, want it to get to, I think there's a real risk of governments turning their back on cryptocurrencies and potentially regulating them or banning them, which would be very negative for their prices longer term. So again, I get the bull market and the bear market. I just think that the bear case for Bitcoin is much more compelling today than the bull case is. So let's talk about student and housing debt. So the chart to the left shows you the total amount of debt outstanding is about the same as it was back in 2008. It's close to $13 trillion. However, the composition of that debt has changed. So at the chart to the left, you can see that housing debt is down, but non-housing debt is up. And the chart to the right will show you that it's primarily been in student loans and auto loans. Now, the question I always get is, will one of these two areas be the next source of systematic downturn? In short, the answer is no. Let's look at student loans first. So as you can see here, student loans are not going to be a macro issue. So there's 44 million student loans outstanding, but a vast majority of them have balances less than $50,000. So although that's hurt consumer spending here throughout this entire recovery, it's not enough where it'll really hinder them from going out and buying a house, starting a family, and doing everything that previous generations have done. But also, a vast majority of the student loan debt is owned by a select few. So 56% of the pie is owned by only 16% of the borrowers. So that's a very good situation. But also, I think it's important to note that if you look at the student loan market, out of the $1.4 trillion that's out there, 92% of it is backstopped by the federal government. So if you see people not paying their student loans, it's not going to have the same effect as housing did on bank balance sheets as we saw a decade ago. So we don't think student loans are going to be a macro issue, at least not enough to throw us into a recession. But what about subprime auto loans? So subprime auto loans are loans given to the weakest borrowers. And although this is a number that's increased dramatically over the course of this recovery, and it's really accelerated since 2013, it pales in comparison to subprime mortgages that we saw in 2008. So just 10 years ago, subprime mortgages made up $1.2 trillion worth of debt. Today, subprime autos is around $275 billion, so it's about one-fifth the size. But there's also some key differentials. First off, banks are in a much better situation today than they were 10 years ago, and the reason being is because of Dodd-Frank. Dodd-Frank has helped banks get a much bigger capital cushion, and because of that, they are in a much better position to be able to deal with losses should they arise in the subprime auto space. Also, borrowers can get their car repossessed much quicker than you can repossess a house. And that was one of the big reasons that 2008 got so dramatic, because banks didn't know what debts laid on each other's balance sheets, so no one wanted to lend to each other. You saw interbank lending seize up very quickly. With auto debt, you can go out and you could repo an auto very quickly, and although the bank may only get 60 cents on the dollar for that repo, it's a debt and a loss that can be recognized immediately, so there's not this guessing game on where the liabilities are in the banking system. But last but not least, people who have an auto loan are much more apt to pay that auto loan first than they are to pay their mortgage loan. So because of these dynamics, if you do see a lot of delinquencies and inevitable defaults in the subprime auto space, it's only going to cause a minor dislocation at best. So we don't see these two areas being the next source of a systematic collapse in the system. But before I get to the next slide, I want to ask everybody to pick up a pen and paper and write down their answers. So we've had 92 years of market returns since 1926, so 92 years. Out of those 92 years, how many years do you think that the market returned more than 20% in that given year? Think about that number, maybe write it down. Out of the same 92 years, how many of those years do you think that the market lost 20% or more in a given year? Write that number down. I think all of you will be surprised to know the answers to those questions. So out of the last 92 years, since 1926, the market has had a positive 20% return or more 34 times. I'm sure that's a much higher number than you're expecting, and if you invest in the markets, you have almost a 40% chance in any given year of getting 20% or greater in your money. If you think about those years that everybody's scared of, those negative 20% years, only 6. So I think this chart does a very good job of showing you the risks and rewards of the market, and that the rewards, if you're investing over the long haul, are very clearly in your favor to be invested in equities. But I think there's a lot of fear right now because we haven't had a big market correction in quite some time. So what we're looking at here is the longest stretch of U.S. performance without a 15% correction. At the very bottom of the chart there, you can see 2018 or the end of 2017, we've seen 1,600 days without a 15% correction. Now, it's human nature to think when you have this positive stretch of performance that the next step is the abyss, that you're going to have a huge downturn. But I'm sure everyone would be surprised to know that we've been here twice before, longer periods of time without a 15% correction in U.S. history. In the 1950s, we almost went 2,100 days without a 15% correction. In the 1990s, we went 1,900. So what that means is we can go another year or year and a half with this being not the longest time without a 15% correction. And because of central bank policy, because of the slow growth nature of this recovery, I think that this will end up being the longest period of time without a 15% correction. But a lot of people are concerned about the markets because of valuation. So what's everybody's favorite valuation to use, right? It's PE. Everybody likes to use PE to say that the market's expensive. Well, if I gave you 2 PEs, tell me which one that you'd rather have. Would you rather have a PE at 16 or PE at 23? Now, I'm sure you probably recognize that this is a trick question, but I've just illustrated the best and the worst time to buy the markets using PE, and if that was your sole valuation metric, it would have given you the opposite signal. So in June 07, the PE of the market was 16. We all know what happened shortly after that. It was the great financial crisis. Not a very good time to buy equities, but it would have told you to buy equities at 16 PE. What about June '09? The PE of the market was 23. A generational buying opportunity. So although we like PE and we think it's a very good valuation metric, it should never be used in isolation. You really want to use it in consortium with a number of different valuation metrics. Whenever you want to identify a major bull market top, a bull market that has a lot of momentum, it's better to look at something that incorporates interest rates. So what we're looking at here is the earnings yield of the S&P 500. So instead of a PE, all we've done is we've swapped the letters. So we put the E on top of the P. And it's a way that we've converted the stock market into a bond. And we looked at three of the longest equity bull markets in U.S. history going back over the last 60 years, 1968, 1987, and 2000. And we compared that earnings yield of the market to the 10-year Treasury yield and what that differential was. So in 1968, you can see at the bottom of the slide, the differential was negative 0.7%. 1987, it was negative 3.7%. 2000, negative 2.4%. But where are we today? 2.2% positive, which tells us at Clearbridge, in order to see a major bull market top, we need to see one of two things happen. We need to see interest rates rise from here to close that gap, or we need to see equity valuations rise from here. And we're of the opinion that you're probably going to see both of those things transpire over the next couple of years to get that number close to zero or even potentially negative. But a lot of people feel that this has been a narrow market, but really has it been? And I would actually argue that it hasn't been a very narrow market, at least not over the last couple of years. So what we're looking at here is the 10 largest stocks in the S&P 500 and what their contribution to the market was in a given year. So in 2015, you can see that the 10 largest stocks in the S&P 500 made up 210% of the total return that year, which means that if it wasn't for those top 10 names, the market return that year would have been negative. That's a very narrow market. And people are concerned when you have a narrow market that when those leaders stop leading and they eventually turn over, the market can no longer chug higher. But if you look at 2016, we had a very broad market. Those top 10 names made up only 21% of the return. And in 2017, even though it's narrowed a little bit, it's only at 32%. So although the market has narrowed, we're nowhere close to the levels that you would typically associate with a market top. But I do think the higher volatility is going to be a consequence of 2018. There is a misconception, however, that higher volatility equates to a negative market experience. The most important question that you need to ask yourself is where volatility is rising from. So when volatility is low and it starts to rise, similar to what we're in right now, your average market return for the next year is 8.8%. It's only when you have high volatility and it continues to rise is where you get those negative market returns. So again, coming off a record low as far as volatility is concerned, I feel fairly confident saying that we're going to be in that 8.8% range where volatility isn't necessarily a bad thing for your portfolio, broadly speaking. But could the market go up higher than most participants think? So if you think about longer-term trends of the S&P 500, you have big trends that are called secular bull markets and secular bear markets. So a secular bear market is a prolonged period of time where the market trades in a sideways fashion. These periods are anywhere from 10 to 15 years. And those are the three time frames that we've highlighted here on the chart. We've had three secular bear markets where the market really just didn't go anywhere. But coming out of those secular bear markets, you usually have what we call a secular bull market, a market that moves dramatically higher over the course of 10 to 20 years. It's not to say that you won't have some cyclical downturns or some smaller recessions, but nonetheless, the market moves the most dramatically during these time frames. So if you look at the top right chart, you can see that we've exited the secular bear market in 2013. It was a 13-year period where the market basically traded flat. Now, it remains to be seen whether or not this will be a secular bull market. We'll only know that in hindsight. But if you think about history, odds would suggest that we're going to continue to move higher, and a secular bull market very well could be the foundation that we're working with. But in order to call a major bull market top, you need to see some sort of behavior being evidenced. And if you look at 2000 and 2007, you had 9 things that were hallmarks that the end of the economic cycle and the end of the market cycle were near, and none of those things are evidencing themselves right now. So you got to see a blow-off top in equities, and I would argue that the The upside that we've seen over the last couple of years has just been an end to the earnings recession and better global growth, not a blow off top. Need to see heavy inflows into equities, and although equity flows have picked up, you still have a substantial amount of flows going to the fixed income market, pick up in M&A activity, pick up in IPO activity, spreads widening out. Until you start to see some of these X's move over to checks, we think that the path of least resistance is higher for the markets, even if we do see a pullback. So to sum it up, Clearbridge is positive on the markets and positive on the economy. Because of our Clearbridge dashboard, we think the odds of a market crash and thus a recession is probably going to happen in 2019 or later. So we think that the market will go up, and even though we've had some volatility here recently, we're looking at that as a long-term buying opportunity because the fundamentals that have made this market and this economic cycle so strong are still very much into place today. So thank you very much for dialing in, and we look forward to seeing you at the next update of the anatomy of a recession.